Hey guys, I'm Karunya Rao, and in Ideas for Profit, all eyes on HeidelbergCement. The company's performance in recent quarters has been quite impressive despite COVID-led disruptions. Improvement in the overall economic activity, including a pickup in infrastructure activity and a solid rebound in housing market, have been driving cement offtake for the company. The second wave had little impact on Heidelberg's operations as revenue for Q1 FY22 came in marginally lower on a sequential basis. Cement offtake for the quarter stood at 1.18 million tons, up 38% YOY. Operating profits grew 21% year-on-year despite a contraction in margins. A sturdy offtake in rural areas, resumption of infrastructure projects and pent-up demand from metro cities aided cement volumes in the quarter gone by. Heidelberg's realizations were largely unchanged owing to the stable pricing environment in the central region. In Q1, sales of the premium segment surged over 80% year-on-year and contributed about 20% to the overall volumes. Gross margins, however, dipped on the back of high raw material costs. Operating margins also came in weaker because of sharp jump in power and fuel costs. Do remember, petcoke has risen more than 50% year-on-year. And of course, rise in freight expenditures mainly linked to crude oil was also a dampener. The EBITDA per ton, however, came in the excess of 1100 despite the jump in cost base. Heidelberg's total investment outlay for FY22 is estimated at 90 to 100 crores. Post-stabilization in demand trends, the company has initiated some maintenance capex to enhance its margin profile and reduce carbon footprint. The company has initiated work on alternative fuels and raw material. This is the AFRM project at its Narsigarh plant and is now looking to set up a 5.5 megawatt solar power plant in the coming months. Heidelberg's near-term volume prospects appear subdued as its plants are already operating at 85 to 90% utilization levels. To enhance its scale, the company is expanding its presence in Gujarat, which will add around 3 million tons of capacity over the next 2 to 3 years. The project is right now in the initial phase as the company is still under the process of getting necessary clearances. Besides, the company has a cash-rich balance sheet and is actively looking at suitable opportunities for inorganic growth. The management is also evaluating the possibility of a merger with its group company, which is Zuari Cement, and has about 8 million tons capacity. This could turn out to be a very big trigger for the company as the combined entity could turn out to be the 6th largest cement player in India. Cement prices in August and September have held firm despite seasonal weakness related to monsoon. With petcoke, coal, oil prices, all of them still trading at elevated levels, the profitability of companies remains at risk if large players are not able to pass on the cost escalation. The management of Heidelberg has indicated that the spike in input costs does remain a cause of worry, but recent cost-saving initiatives will provide some amount of relief in the second half. The cement demand has so far proved to be more resilient than expected. The upswing in demand is expected to sustain in FY22 on the back of higher government spending as well as recovery in commercial and industrial capex. HeidelbergCement continues to see challenges on the COVID front and commodity cost inflation remains an industry-wide issue. However, the business has sustainable growth levers in place that are underscored by a strong market position and solid balance sheet. The management is targeting structural margin improvements while driving meaningful growth on the revenue front. Given the strong business fundamentals of the company, it appears a potential long-term winner for investors. The stock, if you look at the valuations, it's trading at 9.6 times FY22 EV/EBITDA, and according to us, it's worth accumulating on every correction.